Good evening, and thank you for joining us with SouthPoint Investment Services Protect, Preserve, and Provide, a presentation provided by Bob Skillings and Andy Barnick. This evening, we will be muting your phone lines during the presentation. However, we will be opening those up at the end to provide a question and answer series. With that, I'll hand the presentation over to Bob Skillings. Bob?
Thank you, Brad, and thanks to all of you for joining us tonight for this exciting seminar on long-term care. I've worked with clients from a financial and insurance standpoint regarding long-term care since 2006. I've never given an online seminar like this before, and so please bear with me as I try to manipulate the slides and talk at the same time. My real life experience with long-term care is compliments of my mother, as she is in a nursing home in Duluth, and I am her power of attorney. Fortunately, I have two sisters that live in Duluth that are always present for my mom. Most people understand that planning for retirement is important, as is estate planning, but what most don't understand or pursue is how long-term care planning fits in. That's what we want to briefly go over with you this evening. Long-term care generally is the type of care that we need when we no longer can physically or mentally function independently. Our doctor or other healthcare professionals tell us or our loved ones that it is time for assistance, which usually involves the listed activities of daily living, or ADLs as they are commonly referred to: bathing, dressing, toileting, transferring, continence, and eating. It's usually pretty obvious when something physically is wrong, but cognitive impairment is trickier. Cognitive impairment is a significant diminishment of reasoning, intellectual capacity, or memory. This impairment can result in confusion, disorientation, impaired judgment, or memory loss. Either situation might benefit from long-term care services. Home health care can be personal care, supervisory care, nursing care, therapy and homemaker chore services. Community-based care includes adult day centers, senior centers, as well as transportation services and home-delivered meals. Residential care allows for independent living spaces while having access to needed personal care and household support services. Skilled nursing facilities offer a wide range of services, including 24-hour nursing care, supervision, assistance with ADLs, and various types of therapy. Some patients may be in this type of facility for a short time after a serious illness or operation and then return to their own home. Others are in this type of facility because of chronic illness or disability and will live there until they die. 70% of people over 65 will require long-term care services. Nearly 79% of long-term care is received at home or in community settings, and the average long-term care need is 3.8 years. This shows the costs of long-term care, national averages. So in the first column, we have home health aid, and the cost per month for those services on average is $4,385. Adult daycare cost per month average is $1,625. Assisted living, the average cost is $4,051 per month. And nursing home, we see averages there of $7,513 per month and $8,517 per month. My mom in Duluth is about $9,500 per month. I'm going to turn it over to Andy now to talk about the funding options for long-term care.
Hi, I'm Andy Barnick, and so here we are at this slide. And so most folks that, in my experience, are not quite prepared for a stay at long-term care. And so in this slide, it's showing that you're here. So we have to pay for this. So how are we going to pay for this? So the first slide is going to show the self-insured person. You're paying for it yourself out of your retirement or portfolio. Second slide there is going to show long-term care insurance, which Bob's going to cover here in a bit. Third slide there says reallocation. What that really means is we're using insurance and annuities, sometimes in combination, to pay for the long-term care stay, which Bob will also cover. And the last slide there, we're just going to touch a little bit on what Medicare is and what Medicaid is. So Bob, if you want to slip to the next slide there. So self-insuring options for long-term care. So those who do not make plans for long-term care, meaning that they haven't provided funds or bought insurance, oftentimes the biggest thing that they're going to deal with is not having enough assets. Maybe the stock market where their assets are up and down at the time they're using those assets, so it might not be a good timing for it. And the biggest thing is going to be standard of living for themselves, but also for their partner, and how those assets that they've saved their entire life are going to be passed on to beneficiaries, whether they're going to have anything left to pass on to their beneficiaries. I've also been affected by a stay at long-term care. My grandmother experienced what we'll talk about in a second, which is Medicaid, where all of her assets got spent down, which I know the folks online here are probably trying to avoid. So Medicare, though, is the national insurance program designed to provide benefits for hospitalization, surgery, and doctor's care, really. Medicare provides very little coverage for extended long-term care expenses. So some people have an idea that it's not, that it will pay for quite a bit, but really not the case. So here's a little slide that's really helpful, shows that the first 20 days in Medicare, what Medicare will pay, they'll pay 100% of approved amount. And then the next 80 days, they'll pay about $164.50. So really after those first 20 days, you're probably going to be in some need of either self-insuring or having some sort of insurance or one of those annuity-based or insurance-based plans that has a rider to pay for long-term care. And then you see, obviously, beyond 100 days, if you do not have any sort of plan set up, you are going to be completely self-insuring for from then on. And I think the statistic Bob listed was that the average stay is 3 years, and 3 years times what Bob quoted, it's very expensive. So if you want to go to the next slide there, Bob. So Medicaid is the joint federal and state health program that provides medical assistance to low-income families. Persons applying for benefits must prove they do not have the ability or means to pay for their own medical care. A lengthy questionnaire must be completed, disclosing at all assets and income. So the important thing for this slide really is for folks, and I've been doing financial planning since 2005, is you really don't want to go in and apply for Medicaid until you have all your ducks in a row. Reason being is what this slide talks about here, which is most states, including Minnesota, have a 5-year or 60-month look-back period. And so you'll hear oftentimes folks trying to shuffle assets away from that person that might experience a long-term care event before that 5 years is up. Oftentimes it comes a lot quicker than the people think. So you really need to get on the ball and plan it out. So transferring funds during this time will cause a period of where the state or county, really it's county by county, some counties are really stringent, will go back in and look at the 5-year period and see if there was any goofy transferring during that 5-year period, and they'll go back and they'll get it. So that's why you need to have a plan in place. Want to go to the next slide there, Bob? And so asset protection, if you purchase a partnership or qualified long-term care policy, obviously you may protect those assets. So Bob's going to touch on this in just a second. The benefit of this is that you no longer have to hide the assets or worry about transferring the assets. You have insurance to protect your loved ones so that all that money you worked for is protected and you don't have to worry about losing it for this, the last stages of your life, really. But you must declare all assets on the Medicaid application. So that's why it's very important before you go in to the Medicaid office at your county and apply for Medicaid. You really need to have a plan in place because if you go in there and you don't declare some of those assets, believe me, they'll find out. And so you don't want that to happen. I've seen it happen to too many good people. And then lastly, the partnership policies are portable, provided the new state participates in the partnership program. So if you go to a different state, or if you have folks that are living down in Florida or Texas or wherever they're, Arizona, we need to work that plan out. So Bob is going to touch a little bit more here on the actual policies. So I'll turn it back over to Bob.
Thank you, Andy. So yes, there are two kinds of long-term care insurance policies, and they are commonly called a traditional long-term care policy or a hybrid. For the traditional, most are comprehensive to cover all levels of care, which we had gone through on a previous slide. Most are tax qualified. Most are reimbursement, which basically means that the expenses that you have for long-term care, that's what the policy will pay. If requirements for partnership are met, the policy will be considered a partnership qualified policy and will allow the policyholder to protect assets if applying for Medicaid in the future. So if you have a long-term care policy, but that runs out, or the combination of that and other assets get you to the point where you need to rely upon Medicaid, because you had that long-term care policy, whatever that total benefit was of that policy, you'll actually be able to protect that amount of assets. So let's say your policy paid out $200,000 worth of benefits. If you run out, exhaust those benefits and other assets, you would be able to protect up to $200,000. The basic components in a long-term care policy. So they pay daily, weekly, monthly benefits. You usually have a number of years that your policy is good for. There's also what's called an elimination period, which is typically people will choose 90 days. And so what that means is that the first 90 days that you're in a long-term care facility, you have to pay for, but once the 90 days are over, then the policy takes over. It's also a good idea with a long-term care traditional policy to have the inflation rider, as healthcare costs, as we all know, continue to go up. And typically a policy would have a 2%, 3%, 4%, 5%, somewhere in there. And then there's some optional benefits, spousal shared care, spousal waiver of premium, and cash benefits. So when a person applies for long-term care, the factors that are considered in underwriting is your age, the health, marital status, and whether or not you're part of a group, like a work group. So I just went through traditional. The other type that I mentioned was hybrid. And so a hybrid, the asset-based combo or hybrid long-term care policies, these have arisen because of the use it or lose it nature of traditional policies. Many people are reluctant to pay the high premiums for traditional policies because they may never use the insurance, and all those premiums have gone to waste, so to speak. So the industry has begun to offer life insurance and annuity-based long-term care policies. The life insurance option, which this slide shows, has been around for about 20 years. If a client needs long-term care benefits, they are paid out of the death benefit. If a client stays healthy, the entire death benefit is paid to the beneficiary. Most policies also have a residual death benefit, even if all the death benefit has been paid out for long-term care expenses. This type of policy is not partnership qualified, like the traditional long-term care is. This screen shows a couple age 60 and the different options that they have for both traditional, and that's, so in the first column there we have strategies, and we have 2 traditional quotes there, and we have 3 of the hybrid or life insurance type policies. And so you can see the premiums that are paid for those. You might see in there what's referred to as 10 pay. So you would have an option to pay your premiums over 10 years and then you're done. Whereas like in the first row there for the traditional, it says ongoing. That premium you would pay for the rest of your life. Then the third column shows the maximum long-term care benefits that these policies offer. And then the fourth column is death benefit. And so you notice in the traditional, the top 2, there's no death benefit. That's where the use it or lose it comes in. Whereas the 3 on the bottom there are the hybrid life insurance and it shows what the death benefit would be. And so if you don't use that much in terms of long-term care, then the remainder goes to your beneficiary. As I mentioned earlier, the other hybrid is an annuity-based long-term care policy. This would be the go-to option for those that aren't healthy enough to qualify for life insurance. Linked benefit annuity products have been available since 2010. If a client needs long-term care benefits, they are paid out of the premium account and then the long-term care account. And so with an annuity, there will be some leverage from the premium that you put in. There will be some interest that grows into a long-term care account. If the client stays healthy, entire premium account value is paid to the beneficiary. If all of the premium amount has been paid out in long-term care benefits, there will be no account value to pass on. This type of policy is not partnership qualified as well. So regardless of the design, whether it's traditional or hybrid, all of these policies pay benefits the same way. Healthcare professional certifies to the insurance company that the client is chronically ill either due to physical or cognitive illness and physically unable to perform 2 of the 6 ADLs or diagnosis of cognitive impairment. Once again, these are the activities of daily living. Oop. Once the elimination period is met, the policy will start to pay out benefits based on how the policy was designed. Benefits will continue until benefits are exhausted or the policyholder dies, whichever comes first. All benefits paid by traditional or combo products or hybrid products are tax-free to the policyholder. So we're getting to the end here. You spend a lifetime building your estate and purchase life insurance to minimize your risk. You always have homeowners insurance. The fire risk is 1 in 96. Auto insurance, accident risk is 1 in 5. But as you can see there, long-term health needs, the risk is 1 in 2. What are your plans for when your health changes? Thank you for attending. Many people think long-term care has to do with the individual. The reality is that it's a family issue. Think of it this way. The question is not who will take care of you, but what providing that care will do to your family and finances. Long-term care insurance allows your family to provide the care that you want at home or in the community longer and better. It also protects assets that you have allocated to pay for retirement needs. And so now I'll turn it over to Brad for some final comments.
All right, thank you, Bob and Andy. And again, thank you to all of those that are in attendance. This evening, before we started, we did place everyone's computers and phones on mute there. We did that just to make sure we didn't have any interruptions as we began the presentation there. But we are going to go ahead and unmute all of your phones now and computers. And we'd like to open the floor for any questions. Because we've unmuted you from our end, you will still need to click the microphone button there in the web meeting. So you should see a red button with a microphone. Go ahead and click that, and that should fully unmute you to be able to answer, or excuse me, ask any questions, and we'll do our best to answer those for you this evening. So without further ado, do we have any questions from the gallery?
I have a question. I'm single and I'm not married, and I don't know if I'll ever be married. What could I do?
So this is Bob.
Hi, Bob.
Hi. The policies aren't just for those that are married. Policies can be taken out by single. I have some clients, single farmers that want to protect the assets of their land, and so they have single policies.
Okay.
But also, ma'am, I would say this, that we live in a world of supply and demand, and as the biggest generation gets prepared for long-term care, the baby boomers, we have to understand that there's going to be a higher supply. So the better plan that you have laid out will provide for you a better level of care. Wouldn't you say that, Bob?
Oh, yeah, definitely.
Great question. Thank you for asking that. That does certainly come into play when your level of health care is certainly a priority, and certainly you want to maintain a certain lifestyle as best you can. So that was a great question. Thank you so much. Do we have any other? Do we have any other questions at all from the audience this evening?
Is there a particular age that you kind of recommend as being the prime time to start looking into it or to take out a contract?
I would say probably between 50 and 60, you'll find pretty competitive pricing yet. It's rare that I work with anyone that's younger than 50, but it happens. But typically it's between 50 and 60.
And also, I would say that if you look at current interest rates today, Bob mentioned several hybrid products. Those are products that if you have money in the bank, that's not necessarily paying a super high premium right now, you can use those products to leverage yourself into some long-term care protection if you decide not to go for traditional long-term care. And so it really depends on your situation too. Wouldn't you say so, Bob?
Yeah, definitely. really, whether it's a good idea to get a long-term care policy or not, really depends on the assets that you have and what you intend to do with those assets, once you're gone. Some people are, I'm not going to leave anything. I'm going to spend it all, but others, they have other reasons to preserve assets. The last client that I worked with was single. He's a part-time farmer, but had some land, and he was 67, and it turned out that he was paying for a life insurance policy. He was paying $500 a month or something, and he just got tired of it, and so he came to me to see if there were alternatives for that $500. And it turns out that we were able to put him into one of the hybrid long-term care products. So he had not only just a life insurance policy, but he also had long-term care if he needed that. And he was able to afford it with what he was paying before, and it actually was less than what he was paying for that insurance policy he had. So
as a financial planner, the biggest benefit of some of those hybrid products that you can explore is that if you don't use it, you don't lose it. So as Bob stated, as he went through the hybrid products, so they don't necessarily offer the level of care that a traditional plan would, but the important thing is that if you don't spend that money that you put into one of those hybrid products, that you or your beneficiaries will end up still having that money.
Yeah, that's certainly important to have those options available, and that was a great question to get some deeper understanding there. Do we have any other questions from the audience at all this evening? Perhaps while we give a moment just in case anyone is still wanting to get their question in, Andy, what would be a great way to get more information about this? If I'm on the call this evening, or if I'm watching the recorded version, if I wanted to get some more information, what would be the best thing to do in order to get that information from you or Bob?
Well, I think the most important thing for folks that are on the call today is that the credit union is so wants its membership to be so strong and have such a strong product that they've offered 2 financial planners for the members. And so the best play would be to call me and Bob, and we're not going to give you a big financial planning charge to come meet with us and talk about your needs. And to be quite frank, we're going to look at your situation and give you a level answer. So the best way to get the progress started would just be to reach out to me or Bob, depending on where you live. And me or Bob would be happy to meet with you, in your home, or I guess the COVID situation, it depends on your situation, but or at one of our offices or locations. So we have our contact information listed, and also you can go to our website to contact us as well, but we have our emails listed as well. And so I would just feel free to reach out. I've been doing financial planning for a while, and every situation is very unique, but being prepared is one of the most important things that you can do. Ignoring a problem is probably the worst decision you can make.
That's great. That's great. Any other questions at all from our audience this evening? Okay. Well, if you do have any questions, or if you would like to provide any commentary back to us, again, this is our first venture into this platform, and we do hope to bring you more topics at a later date. And hopefully you've gone and been able to get some information out of this evening. Feel free to email either Bob or Andy, or you can certainly feel free to give us a call at one of their phone numbers listed, or a toll-free number as well. So again, we appreciate everybody's time this evening, and thank you to our presenters, Bob Skillings and Andy Barnick. And we hope that you all have a wonderful evening, And thank you again for taking some time to spend it with SouthPoint Investment Services. Have a good evening, everybody.